Joining me on the program is Paul Miron, who is the founder of Msquared Capital, co-founder, but we'll leave the other guy out, eh?
For today.
For today, for today. One thing, and I was thinking about you guys because, you know, in a perfect world, the greater the economic rebound of the Australian economy, the better it is for your business, the better is it for your borrowers, and ultimately it's better for your lenders who basically fund a lot of the projects that you fund.
Absolutely. So the confidence that we're seeing this quarter in comparison to when we had last year of COVID, there are a lot more investors prepared to invest into mortgages. There's a lot more borrowers who are seeing opportunities to borrow money, to make money as well. Yeah. So it is a much more buoyant situation that we've seen last year.
For people who haven't seen you on this program before, just in a nutshell, what does Msquared Capital do?
Look, we're a private credit provider, meaning that we match opportunities for our investors to invest into direct mortgages. More importantly, we have the platform to allow each investor to choose the type of investment which is best suited for them. And I've been on the show many times. There's a misunderstanding with a lot of consumers or a lot of investors in relation to how to invest in mortgages. A lot of people know what a pooled fund is, that you just, you write a check, there's 50, 60 mortgages, but the variability in mortgages is significant. You might be investing in something which is a construction deal in regional Australia, in the same pool of assets where it could be against a unit in Parramatta.
So you're not pooled, you're unpooled.
We're not pooled. We allow investors to invest intelligently and choose the right opportunity for them. And the benefit in doing so, they can control the risk and they can increase the return.
Okay, so in simple terms, someone comes in, they might want to borrow $5 million, right?
That's right.
Okay. You then say to them, well, we want some kind of security lending you $5 million. Yeah. What is that security?
Look, the security is we take first mortgage. We normally never go over 65%. And what that means is if the value of the property at the present moment is $5 million, we'll not lend more than 65% value of that property.
Yeah. So that guy, for example, he wanted to borrow $6 million. If he had a $10 million property, you could lend to him because $6 million over 10 is 60%.
Absolutely.
Okay, that gives you a margin of safety. But then you got to try and fund that $6 million. You don't give it to me personally. No. You go to your investors,
even though
who are effectively are savers, and they say, well, look, if you like the idea of this project, you can put some money into it, and that's the way you do it.
And we do more than that. We actually source the opportunity, and we put a due diligence pack for our investors, and it's not just looking at the security. It's the quality of the security, it's the quality of the borrower, and you have other elements.
And the quality of the deal he wants to put the money into.
Absolutely. Okay, and it may not just be a deal. Right now, because of COVID, we got a lot of people putting money, they want to borrow against their properties to put money into their business. Because they see an opportunity coming out of COVID, that the business activity is improving, they want to jump on that as well. So we find niches in the market where we can move very quickly, and our competitors are not.
And we should say, this is not a government guaranteed savings deposit because they're paying about 0.5%. You guys pay a lot more.
We the minimum or the lowest return deal that we've done in our fund so far was about 6.7%. Just to give you an idea, average it's about first mortgage at 65. You're looking at 7s.
Yeah, and the bigger the potential return, that is more risky than the lowest return.
Absolutely, and we do the risk analysis on each particular deal, so we appropriately charge the borrower and give that best return for capital.
And let's go back to my first question then. In that context, the better the economy, the better the opportunities, effectively the better it is for your business and your investors.
Well, there's more opportunity on both sides. There's more investors, there's more borrowers as well, and there's more confidence.
And the borrower's potential deals are going to be better in a stronger economy as well.
Precisely.
Generally speaking. Okay. All right. So there's been some spookiness about the bond market telling us that possibly interest rates could rise faster than expected. Does a rising interest rate environment affect your business?
There's two parts of it. We're looking, like if you look at it from a macroeconomic perspective, I think in the current market, the scare with the bond market is that if interest rates go up too quickly, or inflation goes up too quickly, and RBA doesn't have enough control, The issue there is that we haven't given our economy enough time to recover. You still have to consider that our unemployment rate is 6.6%. But prior to the crisis, it was in the fours. So we haven't reached that capacity yet, and a sudden increase in interest rates, what we're concerned about could happen is that people get less confident. And as I said before, more confidence, more opportunities, less confidence, less opportunities. So that we look at that's from a macro perspective. However, even if that is the worst case scenario, we still find opportunities. We still find opportunity for our investors, and we still find good opportunities because sometimes the banks get a little bit less, they get a lot generous or more reluctant to lend money, and we can assess that. We can assess that risk, and we can actually give those opportunities to our investors as well.
Do you think that the Reserve Bank will have its way and it will hold interest rates down for at least 2 years? They've said 3.
Yeah.
My best guess is because things are looking so strong, they might wait 2 years. But I got a funny feeling they can hold it for 2 years.
I agree with you. Like the initial reaction when last week with the bond market going a little bit crazy, the 10 and 30-year bond rates going up very suddenly, and plus all of the GDP figures coming out, inflation figures are all much better than what we expected.
Yeah.
I still think that they have a lot in reserve to keep those interest rates down. They got QE2 and QE3, which is a significant amount of money. We're talking about billions of dollars that they have available to buy the 3-year bond rate to keep those interest rates low.
Yeah.
So I think they know exactly what they're doing, and they're.
In America, they say don't fight the Fed. We haven't got the equivalent, but our Reserve Bank is like the Fed.
Yeah.
They've got a bit of firepower.
Absolutely.
All right, mate. Let's talk about. I'm curious because you guys actually look at this, not just the cities you're going to lend to, and you've had a bias towards the East Coast.
Yes.
Since I've known you, but you also have a bias in terms of suburbs that are doing really well and the suburbs that not, because the person who comes to borrow from you, if he or she puts a house up, you got to look at the value of that house, the future of it, so you got to know the potential of a suburb or not. And you picked a couple in Sydney suburbs that have really struggled. Tell us about that.
Well, see, it's very easy to read the headlines, and the headline for this month is that Sydney property prices, house prices, not property prices, house prices have gone up by 2.7 or 2.5% in 1 month.
Yeah.
Now that's quite significant. That's the quickest up movement in 1 month that we've had in 17 years. Now, but not all property markets are the same. So what we do is we have our own internal property research house as well, and we look at data a lot more carefully. So when you look at houses, they're in short supply and they're in high demand. There are a couple of factors why. It's because it's only occupiers that are very active in the market. You've got expats coming from overseas with a lot of cash in their money in their bank pockets, and they can afford to pay an extra $500,000 to buy the 400 square metre house in the eastern suburbs area or Mossman, for example. That's very rare. So that's what we're seeing in the market right now. But the real story behind this as well, and we've done analysis 18 months ago, we do what's called a demand supply analysis. And so in the unit market, for example, the Parramatta area, for example, we notified that as being an oversupplied area 18 months ago. And as a result, the statistics that just came out this month is that unit prices in that area have fallen by 13%. There's other areas like Relied where you've had a lot of, and obviously COVID hasn't helped as well, you've had a lot of supply coming onto the market and it was already oversupplied. Plus, you have the issue with the fact that we've had COVID, international students are not here, rents are falling, and we've got a lot of internal migration. So people looking for more space, they don't need to be in those central areas. They're going further out, and they're preferring houses. And the other thing that's a very interesting trend, you got all of the significant incentives to first-owner home buyers. Now, if they got an option to rent somewhere, versus owning their own property, and it's going to be a house so they can build a new one, which one are you going to choose?
With interest rates around 2%, why not?
Yeah.
So the important point then is, and this is a question I get a lot, is city apartments. They really are lacking customers.
Yeah.
A, are the prices falling? And B, do they represent a potential good buy for the future?
Look, our personal belief is that it will recover. And what the gap between houses and units are widening a lot more. But once we have a market which goes back to normal with migration and all the students come back to Sydney, Melbourne and Brisbane, I think it will continue going down that trend. So it might take a year, it might take 2 years. The risk for an investor is obviously buying that property and having a much lower rent than they expected, but it might be a 12 to 24 month strategy for them. We have no issue lending against those assets as long as we apply the appropriate gearing towards it. And we have enough mitigants to mitigate the fact that that asset might fall another 5%.
Okay. Is there anything else you think you'd like to share with us? Because you're here primarily as a person, a business that's at the coalface of the property market.
Yeah.
Is there any other important point you've noted in recent time?
Look, I think a lot of people sitting back at home and thinking about, wow, are we really in the property boom? And there's some analysis which is worthwhile talking about in relation, or is it going to bust overnight?
Yeah.
So
is it a bubble ready to burst?
Is a bubble ready to burst? Look, if you really think about it, since 2017, we're now back to the same prices that we had in 2017.
Yep.
If the market, for example, overheats, and we can look at New Zealand, for example, I think we already have a test case in Australia where in 2017, Prudential Authority came in and said, look, I think people are taking on too much debt, house price going too quickly. And if you think back what we did, or what the government did, it made it harder for people to borrow money. And that made an impact where proper prices fell, that 15%. So if anyone's there sitting and thinking this is a bubble, I personally don't think so. In 2017, you had interest rates at 4%. Now you can get a home loan under 2%. So the Reserve Bank has done analysis where 1% decrease in interest rates, that's pretty much an 8% increase in property value. So I think that if interest rates are low for the next 3 or 4 years, we'll probably see that uplift. Will it overshoot? Well, I think the RBA is going to be very comfortable for it to go up to 30%. But anything over that, they'll probably put some prudential authorities to put the brakes on it.
Yeah, and I think there are people out there who believe that the housing market, if it's a bubble, can only be addressed by a pin going in there and it bursts, rather than being able to undo the balloon and let some air out. And that's what APRA does when it says, let's slow down the amount of loans that banks and lenders are making.
Yeah, and I think the real collapse comes from when you have a significant oversupply of property. Now, we're not going to see it in the market for a long time.
That's right.
So,
but I guess the point you are making about apartments, that in that particular chunk of the market, there is oversupply, but even over time, that should be taken
it will
up.
be absorbed very quickly, and it's temporary, and the amount of new projects coming out is a fraction of what was happening 3 or 4 years ago.
Thanks, mate.
No problem, thank you.
That's Paul Miron from Msquared Capital.